Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of that mission, we do these free mentoring sessions every week, almost week after week after week, month after month, month after month, and year after year after year. So this is the 420th session. We started back in the fall of 2008. So it's been a very long journey. We've been here consistently for you for many, many, many years now. The event is being recorded. You'll find the roundtable recording at our 1M1M Roundtable's YouTube channel. It will also show up on our blog if you're a follower of the blog. If you are live tweeting the show today, please use hashtag 1M1M. And on Twitter, you will find us at 1Mby1M and at Romana. We publish a lot of interesting content, rich, inspirational, educational, informative content. Now, this is a roundtable, not a broadcast, so we want you to participate as much as you wish to. So these are the call-in instructions. We will put these call-in instructions back up a little bit later in the program. Meanwhile, use the public chat to ask your questions, and I will definitely pick up questions from the public chat. We have a few entrepreneur pitches to begin with. That's the first part of the session. So let me set some expectations for those of you who are planning to pitch today. We are on your side. This is a safe working session. You can bring whatever it is that you're struggling with here so that we can discuss and give you some inputs with which you can move forward. We can, help you check your assumptions, check your, path forward. But that's all this is. It's nothing to be scared of. It's nothing to be nervous about. We're on your side. Now, it's okay if you disagree with my feedback. That's perfectly all right. Don't feel bad. It's your venture. You will do as you wish with it. One thing you must remember, though, that not all businesses can raise money. Not all businesses should raise money, and raising money doesn't guarantee success. This is a fact. This is a non-negotiable fact. And you have to factor that in as you determine your strategy through the course of the entrepreneurial journey. So I believe Elvis is not on the call. Elvis is in Ghana, and there's some technical issues. But we're going to start today with Erhard. And I will put up Erhard's slides in just a moment. Here we go. Erhard, you are up first.
Okay, thank you. And hello, everybody, and good morning to California. So I'm Erhard Frenholz. I'm the CEO, Managing Director of Telexos in Germany. And we are working on the next generation liquid biopsy for personalized cancer diagnostics. Next slide, please. A few words to liquid biopsy. So in opposite to the tissue biopsy, you take a blood sample and you analyze the blood sample for cancer entities. And this has many advantages. For instance, for the patient, it's less painful, but you can follow the therapy much more closely, and you can determine if the therapy effective or not effective, and therefore can save costs for patients and health insurances. Next slide, please. Liquid biopsy has been evaluated by JP Morgan this year. The market was determined as something like 22 million in 2020, so it is a very significant market. Next slide, please. And accordingly, there are huge investments going on in liquid biopsy, in particular in the US. So the last one was the second one on the right side. The Biotechnie has acquired exosome diagnostics for something like 600 million. So there are a lot of costs involved here. Next slide, please. So the question is now, what is then special with Telexos? Why to invest in Telexos? First of all, we are working on the analysis of so-called circulating tumor cells because that is the entity containing all information about the tumor, very important. And we are the only company which detects those cells in the blood sample completely, and in addition deposits it as single cells because they are quite heterogeneous. And in addition, we have a very experienced team, and come back to this later. Next slide, please. So Telexos offers products along a unique and proprietary workflow. You can see here, starting with the workup of a blood sample and ending up with the analysis of those deposited cells to recommend the therapy. And we bring those products, which are reagents and devices, to cancer clinics, which are our customers. Next slide, please. And just to have an impression how efficient our technology is, we have here a comparison with the market leader. The market leader is Veridex. It was originally a Johnson & Johnson company. And we compared it with real samples, and we detected all of the CTC positive samples of Veridex as a result. In addition, we detect over 150% more CTC positive samples, and in total, over 400% more CTCs in those samples compared to Veridex. So we improved the detection quite a bit. Next slide, please. Just maybe 2 words in respect to the management team. So I worked over 20 years with Roche, and also as a project lead with circulating tumor cells. Klaus, also co-founder, also worked with diagnostics and business development, license partnering. So we fit very well to each other. Next slide, please. We made an initial product introduction plan that is based on actually 2 waves of introductions. One is for the so-called medicinal research market, and the second one on the right side is for the diagnostic market, that as a final end. Next slide, please. And based on this, we defined milestones, 2 milestones currently. The first milestone is ending up with the launch of the products into the medical research market, and we calculated costs of about 8.7 million. The second milestone is then to bring everything in the diagnostic market, including having the clinical studies, and that's calculated at about 11 million. Next slide, please. And of course, we have calculated our revenue forecasts, which are significant, although we make the introduction first into a limited region, so not worldwide. And we make it, as mentioned, to the research market first and then to the diagnostic market. To the research market in about 2 years, and the diagnostic market in about 4 years. Next slide, please. And we have to think about the venture capital aspect. So we have an exit strategy, of course, and we do have it. So we consider a trade sale. And there are 2 possibilities. So one is trade sale to candidates in the research market, and the other one is candidates in the diagnostic market. And there are several options, and we have to see how everything is developing. Next slide, please. As an example for a diagnostic deal for liquid biopsy, there is currently only one example there, which is described in public. The other examples are not public, so we don't know the amount of money. So this one here is Exosome Diagnostics, was acquired by Biotechne, and for $600 million. And interestingly, the product portfolio which they had on the market was not yet approved by the FDA, so they were working on the research market. Next slide, please. So those are the stakeholders which I mentioned already in the beginning, and I think that is the end of my talk. Thank you.
So, Erhard, this company that you're talking about that went through the acquisition, how long after their founding did this acquisition take place? Because you're saying that they didn't have any FDA approval from a product point of view. So what was the stage of their product?
The stage, they have a complete product portfolio for several cancers. Mm-hmm. And but they were on, I think they were founded something like 2004, 2006, I think, in this area. And we know the company well. They are not so well detecting or equipped to monitor therapies. But anyway, they got acquired by Biotechne, and good for them, I would say.
So about 12 years after their founding is what you're saying, but without FDA approval.
Yes.
Interesting. Okay. Now the other companies that you were showing in your, let me see, I'll go back to your competitive slide.
Keep going.
No, hold on. This one, you are showing a bunch of liquid biopsy companies that got funded.
Yeah.
I would advise you to take a look at where in their cycle are each of these companies. When were they founded? When, how far along are they? Do they have product? Do they have FDA? Whatever, where they are, and what points have they raised money in?
Yeah, we know exactly the points of each company.
Okay. So I guess the question really that you're going to need to figure out is at what point is money coming into these companies? And how do you compare with that?
The problem is here that we are looking for money in Europe, and the VCs are hesitating to invest in liquid biopsy currently. It's very different in the U.S. There are many VCs investing into the companies. Look, Grail, for instance, there's Bezos money in it. There's a lot of money in it. Or also with the Epic Science in San Diego, they just finished the Series E with they're gathering $52 million. Again, in total, I think they have $130 million collected. And we know
but where
that...
is Series A from? The question that you need to ask, you're looking for Series A. So I think the question that you should try to analyze these companies and see what point in their evolution did they get Series A and what did they have in the company to get to Series A. San Diego, by the way, is a big pharma hub. There are a lot of pharma companies in San Diego.
Yeah. So, for instance, it's very mixed. Yeah. So, Grail, for instance, is a company originally founded by Illumina, and they exist now almost 2 years, just 2 years. So they're still at the very beginning, but they raised huge money, in particular in California. So There's Bill Gates money in it, there's Bezos money in it, and then after this, I think 4 pharma companies put their money in it.
And how did you find out about 1 million by 1 million?
Coincidentally, so somebody told me, one of my friends told me about your platform, and that's great. That's great. That's really great.
So the reason I'm asking you is that we don't do pharma. We do, on the healthcare side, we do digital health, healthcare IT. We don't do pharma. So
okay.
I'm not an expert in pharma. I'm not an expert in pharma fundraising. Because the cycle of fundraising is very different from the IT or digital side.
I see. Okay. I mean, this is not pharma, this is diagnostic, but it is also life science. That's right.
But it is, I mean, it's diagnostic, but it will go through the pharma, it goes through the pharma cycle. It will need FDA, it will need, it's a different method of building companies, and that's not where our expertise is.
Opposite. Oh, I see. Okay.
And that is not where our networks are either. So I think it would be dishonest for me to say that we have expertise in what you are doing. We don't. But I'm just asking you these questions more from kind of common sense, is that when, we have a methodology that we use in all our work is the notion of comparables. And you started this presentation by showing a bunch of comparables where money has been raised based on certain parameters. So what I would encourage you to do is really analyze those parameters of exactly where in their evolution did they raise Series A, whom did they raise Series A from, and kind of make that list, make that analysis and study, and then you can potentially find the companies that are the investors that are in that stage, people who do Series A pharma investments. You have to very specifically find, there are people who would do Series B, Series C, Series D, E. That's a different category. Each of those are different categories of investors. In our practice, for example, we do a very clear analysis of who does pre-seed, who does seed, who does post-seed, who does pre-Series A, who does Series A, Series B, etc. We know, we work with hundreds of investors, and we understand where people's center of gravity is. You have to do the same thing to understand in the pharma investment cycle, and they could be American investors, but you need to find those pharma investors who do Series A, and then try to get to them through your network.
Mm-hmm. Mm-hmm.
Make sense?
Makes absolutely sense. We analyze those, but we also try to approach some of these VCs, and we never got an answer. And
you're going to need to go through people. VCs tend to not like cold approaches. You're going to need to be introduced. So I would recommend that you create your list, take your list of VCs and see who can connect you, introduce into those VCs.
I see. Okay. And
so do your research on LinkedIn to find whom do you know who is connected to those VCs. And typically you would find people whom you know, or at least build relationships with people who do know. Like in our case, in the domain where we are active in digital health, in healthcare IT, we would be the people introducing our portfolio companies. We have the relationships, we know these people, we would make the introductions, and that would work fine. But here, in the case of pharma, you need to find somebody who can broker those introductions.
I see. Okay. Yeah, that makes sense. Makes sense.
All right. Yes. Good luck.
Thank you.
Maureen, who's going next? Is Elvis on the phone?
Yes, I am on the phone.
Elvis, just a second. Let me go to your slides. I'm glad you sorted out your technicalities. One moment. Here we go. Here are your slides. So go ahead.
All right. Good afternoon. Thank you again for your time. I'll go through this pretty quickly. TrimesterSave is primarily a proposition for financial inclusion. So it's more in the impact investing space where we take on the matter over a period of 7 to 9 months, and they carry out micro savings as part of their best preparedness. This is so that they can achieve better financial protection and avoid the financial risk associated with childbirth. Next slide. It is primarily focused on poor women, and apart from sending financial literacy messages and also getting them to actually save with our banking partner, we also integrate pregnancy messages to do with safe pregnancy. So there's no point saving to give birth if you are going to die at the end of the day. So we include that as well.
Okay.
So we've been piloting in Ghana with the support of the United Nations Development Fund, but the idea is to go as far as possible. So we have some figures of just not the actual populations, that they are far more than these. These are the actual number of births per year. So that means it's a very good proxy for the number of women who give birth every year, if you subtract twins, for example. And so these are the figures. And so it goes all over from West Africa to Africa to the world. And you see Bangladesh, Brazil, and Mexico, Philippines, where the numbers are pretty high. Next slide, please. So the business model is, first of all, based on what I've described already, have an integrated e-health or mobile health service that works with a fintech service. And what this does is to prompt them to carry out savings, but it also has neat features such as timing your gestational age with your cash out date. So if you put in the gestational age into the system, it automatically calculates what is the EDD, the expected date of delivery, and then we know that that's the day that you need money as well, or around that time, roughly. So you calculate that, and then they set targets for every trimester, because you don't want to wake up in the 9th month and say, oh, you hit your target, or oh, you didn't get enough. So every trimester, the system will read and see whether you are hitting the target. That is that's what the primary business goal is. The other thing is, after they save for 7 to 9 months, they get what is a proxy credit score, and therefore can be able to acquire credit a little bit more easily. And then, since we onboard in antenatal schools for now, we are not completely digital, they can form groups. And the UNCDF is pushing this, where as groups within the same community, they can get a better leverage for getting group loans. This is accepted in the financial sector as having a better portfolio, because they end up paying the loans that they take as groups more than those that they take as individuals. And then, of course, as it grows, we are anticipating people who want to get our target audience, like fast-moving consumer goods and services, baby care products, partnerships. And so these will be added value services that we hope can bring in additional revenue.
So who is paying?
Yes, so paying for this is, we've started very gently. So for the banking partner, they are the ones keeping the float. So the primary place for this is, we are operating, although it's our idea, we are operating as an agency where they pay us for onboarding clients onto their savings program. So we are just giving them.
Is your assumption that these are mostly unbanked customers that you're bringing into the bank's platform for the first time?
Yes, primarily unbanked and financially excluded customers. For a few of them who will become premium customers, they may just want a specific savings plan that they know is reserved for their baby. So that's financial management. They just want to manage their finances by having a separate savings plan for their baby, but primarily it's financial inclusion, so onboarding onto the bank, and the value is from there. Then it is assumed that 20 to 25% of them would try to access loans later on, and then we get a percentage of that loan because the portfolio is better, estimated at 10 to 15 times better than giving a loan to anyone from the general population, 10 to 15%.
So your assumption is that the banks are paying for this as a customer acquisition cost?
Yes. So although we haven't collected the revenue yet because we wanted to prove the model, they have a customer acquisition cost, yes, the CAC, and that we
have you validated this assumption that banks are willing to pay?
Yes. So we've piloted this for the last 9 months. Most of it has been trying to get through red tape with the Ghana Health Service. And so, but on practice, we've onboarded we've reached about 700. Today, I know just 50 are actively saving, but the bank is willing to pay through our NDA with them. They are willing to pay for onboarding. It's very insignificant as far as they are willing to pay, but it's still a sign that they see it as an opportunity.
I guess the question I'm asking is that how does this business make money? And if I'm looking at this as a business, what are the metrics? How do you make money as a business? And that question needs to be answered.
So we make money by charging the bank a customer acquisition cost, number one, by charging a percentage of loans that our clients access from the banks because we brought them to the bank in the first place. So a percentage of the loans they make they take from the bank will be given to us as though the bank hired us to go look for loans.
These assumptions, have you validated them?
It's not fully validated yet, except that the bank was willing to pilot, and that's the phase we are in right now.
All right. Okay, so what is this? What is Vodafone?
Yes, so in addition to the banks, we, like you said, the revenue lines are very low, so we are trying to cut down costs as much as possible. So Vodafone, for example, in East Africa, has a high customer base, and so we'll try to get them to introduce us to their customers and onboard their customers onto this program. Not from the financial inclusion perspective, but just for the sake that they want to have a safe kind of a savings plan for their children. That would reduce our customer acquisition costs to a very low amount and make sense when we get very high numbers onboarded for the banks by way of revenue.
Okay.
Yes, so that is it. And why would Vodafone come on board? They have the interest area of being able to give certain premium services to particular clients by looking at their behavior in spending credit. And they can also send promotions to them and say, if you buy 10 CDs of Vodafone credit, we will save 1 Ghana cedis to your savings plan account. So that is the interest area of Vodafone and why they will work with us, because they see that they can advance some value-added service through it.
Okay.
Yes, so the team is myself, Then there is Divine, and we have some managing coordinators. As far as technology is concerned, at the moment, it is quite honestly outsourced. Part is done from the bank, and a little is done by our platform by way of the gestational age tracking. So basically, that is it. We had an investor interest just last week from the perspective of being an impact investor who wants 40% of this take. I wanted your input into that.
I don't think this is ready for investment because I think the pitch that you just made doesn't cover what an investor should be questioning you on. So if you have an investor that's just coming in and straight away asking you for 40% ownership, it just tells me that this is not a very experienced or savvy investor, and being saddled with dumb money is not a good way. And getting saddled with dumb money that owns 40% of your company is a very bad way to build a business. So my recommendation is that you really need to create a strategy that is much better suited. If you are thinking about raising money, even if it's impact investment, you need to raise money in a way that is reasonable and in a way that makes sense for investors. Right now, your presentation doesn't cover the elements that are necessary for a real investor, for a smart investor, to even assess what this is all about. What are we investing in? The other comment I have is you should try to get a pilot going that really validates your assumptions about banks and so forth in one geography. And maybe it's just Ghana. You don't need to do so many geographies right out of the gate. It's not possible to do so many geographies right out of the gate. You should do Ghana and figure out what is the model in which you are going to be doing this and who's paying, how does the business make money. Because without that understanding, no investor should be investing in this company.
Yes, thank you. But I think that is one of the reasons for this investor. I wanted him on board because he was he's a technical person, and he's set up several projects like this across sub-Saharan Africa. And he feels he wants to settle now and build something, and he feels this is what. So I think he's going to restructure everything. I just think that 40% may be a little too much, but it's actually
how much
not
money? 40% for how much money is he putting in? Is he putting in $40 million?
No, I have put in $25,000 already in value. Everything that we've done with cash and everything, and he says he's putting in another $20,000, and his expertise will be $20,000.
He's going to get 40% of your company for $20,000. This is a terrible deal, Elvis. This is a terrible deal.
Okay.
This is an absolutely terrible deal.
All right.
This makes no sense to me.
Yeah. So what do you think? If I said I don't want your money, I want him on board as a technical person, I can't pay him 5 to 10%, or?
No.
But don't you believe in the model where you are getting a technical person to join your team and you can't pay him, so you want him to take shares?
You should not, right now, you should first fix your strategy before bringing a technical person on. You're not ready to bring a technical person on. You don't really know what you're doing. You first figure out what you're doing before you bring a technical person on. Right now, you bring a technical person on and you do a bunch of this, that, and other things. You waste 5-10% of equity, which is not strategic. You're going to build stuff that is not strategic. This business is very raw. It doesn't have clarity on what you're doing. It needs enormous amount of strategic, reformatting to be able to get to something meaningful.
My last
It's very
question,
nebulous.
do you think a doctor has that capacity? You think I'll be able to think through this from a business perspective as a doctor?
You need to learn how to think through a business from a business perspective. And I recommend that if you want to build a business, either you go back and do your medicine, practice medicine. Don't worry about building a business. But if you want to build a business, then you need to get yourself trained. Otherwise, you're going to be taken advantage of left, right, and center.
Okay.
So if you hold on, I'm going to explain how to use the 1 million by 1 million program to learn what you need to learn as the first step, in a very, very inexpensive way, but you're going to have to put in some time to train yourself. And this, I believe that every entrepreneur who decides that he or she wants to be an entrepreneur needs to have some basic entrepreneurial knowledge. And that's something we can help you with. But without that knowledge, you shouldn't be doing a company, a business.
All right. Thank you very much.
You're very welcome. Hold on for a second. I will explain to you a bit more. Parul Gujral is next. I'm going to your slides, Parul, so just give me a moment. Where is Parul's slides? Snowball, is that the company?
Snowball is the company. There they are. All
right, go on.
And I bet I surprised you when I turned my camera on and you saw there was a gentleman behind the screen. Parul is a lady's name on the other side of the world. But it's a pleasure to speak with you. I have to apologize in advance because my slides are mostly half-baked and in the process of being evolved. But I'm grateful for this opportunity to speak with you today.
Sure.
And I'm actually in Miami, not in San Francisco, here for business, in trajectory to Puerto Rico to speak at a conference. But I'm here to talk to you about Snowball, the first smart crypto investment automation platform. So just to get started, let me ask you, have you invested in cryptocurrencies before?
No, I do not invest in cryptocurrency. Thank you.
You do not. Have you ever?
No.
Okay. So
and I will
you're
never.
Not familiar. And you will never. That's a very interesting statement that you made. Well, why don't we go to the next slide? So once money goes, this is an interesting thought for you because you have a very strong perspective of never, or investment thesis of never investing in a volatile currency of cryptocurrencies. But I want to challenge you with this point. Once money goes digital, it's never going back. And think about this. Really, really think about this. Money already is digital, right? Mm-hmm. To the supermarket, when you go shopping, how are you paying? What's the medium of exchange? Credit card. Sometimes,
so I'll just kind of, reset your thinking vis-a-vis me and my comment. I don't invest in currency arbitrage. I live a fairly high-risk life elsewhere in my professional life because I'm a startup person. So I work with small companies, startups, and so forth. So, as far as investments is concerned, my investment strategy is relatively old-fashioned. It's stocks and mutual funds and so forth. So I don't do currency investment, period. So it's nothing to do with crypto or nothing. I just don't do currency arbitrage.
Well, hopefully after this presentation, you may have a new perspective and reconsider. Actually, especially because there was a recent study that came out by Yale University, which stated that one should invest up to 6% of their portfolio into cryptocurrencies. And here's why. Because cryptocurrencies have no correlation to the stock market. They have no correlation to the bond market. They have no correlation to real estate. They have no correlation to gold. And so as a result, you actually have risk-adjusted return by diversifying your portfolio, at least a portion of your portfolio, minority of your portfolio in cryptocurrencies. There was another study that came out that said that if you put up to 5% of your portfolio in a diverse portfolio of cryptocurrencies with a 55% weighted in stocks and 40% weighted in bonds, not only did you minimize your drawdowns, but over a 4-year weighted period of time, you were likely to double your portfolio value. And these are some of the facts. And as a result, actually, many institutions are investing into cryptocurrencies, a minority of their portfolio. So you could see Yale, Harvard, UPenn. You've got institutions like Fidelity. NASDAQ is now becoming the security token offering leeway for any companies that are offering security tokens.
I'll just give you the go-to-market perspective on what you're saying, that if you're looking to get to individual investors and tap into their portfolios, you're going to need to come in through, my private bank is Morgan Stanley. So you're going to need to come in through Morgan Stanley and the wealth advisors there and the instruments, the financial instruments through which we invest, in collaboration with Morgan Stanley. So I think
absolutely,
if you want to tap into the, H&I category, you're going to need to come in through the wealth managers.
I'll also challenge that as well. While I think that's an impeccable opportunity to partner with institutions, the Merrill Lynch's, the Morgan Stanley, et cetera, to be able to capture the retail market. If you look at companies like Acorns, like Stash, like Betterment, like Wealthfront, the majority of their users are millennial users that are making if you're looking at the Wealthfronts and Betterments, they're making substantial amount of capital. If you're looking at the Acorns, they're investing their spare change. And these folks are not coming in through these traditional financial institutions.
Those are robo-advisor companies. The robo-advisors are creating financial instruments and recommendation systems through which they are managing their portfolios. They're not doing it all entirely manually by themselves.
Sure. And that is actually the point that we're trying to make, because we call ourselves the wealth front for cryptocurrencies. We are the first smart crypto investment automation platform. And I'll get to that in a bit, but really let's take a couple steps back and really focus on what the main problem is here. It is said that we're under perhaps the biggest financial revolutions of our lifetimes, where we're seeing fiat currencies transpire and evolve into digital currencies. And as a result, we're living in a decentralized market, which is by nature deregulated. And the folks with the deepest pockets actually have the best opportunities. They're the ones who are coming. They're called whale groups. They're coming in and they're pumping and dumping different tokens. And in a bull market, everyone's an expert. But when the bears come out, the retail investor loses their shirt. So if you're looking at just this year, the average retail investor lost 70% of their portfolio, while the average fund lost 20 to 40%. But there's some funds that are arbitrage funds that are making 80% this year, or the quant funds are less, they're up a few percent or just down a few percent. And so the question is, how do we make it so everyone has the opportunity to play, and if they play, they have the opportunity to win? And so the challenge is that right now, all of the financial resources when it comes to smart crypto investment goes to 1%. And so that means if you want someone whose livelihood is investing in cryptocurrencies that is regulated by the SEC, by FINRA, by FinCEN, that has a minimum of $10 million assets under management or more, you need to be an accredited investor, which means you need to make $200,000 a year or more, or have $1 million of assets not including your primary household, which is a fraction of a percent in the United States. And so you want to, invest in cryptocurrencies. So you can go to the next slide. How do you get started? Who do you trust? And how do you sleep at nighttime? Today, if you want to invest in a portfolio of cryptocurrencies and you're not the 1%, you have to sign up for multiple exchanges. So let me give you an example. If you'd like to buy Ripple, which is the number 3 or number 4 cryptocurrency, you have to sign up for Coinbase or Gemini. You need to buy Bitcoin. You need to transfer your fiat currency. You need to go through the KYC process. Then you need to sign up for another exchange like Binance. Then you need to take your Bitcoin and transfer it from Coinbase to Binance. Now, it takes, approximately 30 minutes on a day of high volume and traffic. It could take much more for that. And if you're an unsavvy investor, you're pulling your hair out because your money has effectively disappeared. In addition to that, if you go to these exchanges, like Binance, they look like a gambling site from, the early 2000s. And so the UI is not optimized for the first world eyes. And so there's a lot of anxiety. The theft is rampant. Exchanges are being hacked. And the process is extremely meticulous. So you have to learn the technology. You need to learn how to, sign up for these multiple exchanges. You need to understand the market and create your own investment thesis. Which tokens do you buy? When do you buy them? When do you sell them? And then you need to put in the time because the crypto market doesn't sleep when you do. And so how do you play if you're a retail investor, if you're the 99%? Well, you can invest via Snowball. So Snowball is the first smart crypto investment, or SCIA, platform that empowers everyone to make smart investments. Go to the next slide. So what's a smart investment? So a smart investment is an investment which is curated by a regulatory compliant crypto fund that has a minimum of $10 million of assets under management, and hence they have a fiduciary responsibility not only to their LPs and investors, but they have a fiduciary responsibility to themselves because they're taking a big margin of the profit, and ultimately the GPs are invested themselves. And so what does Snowball do? Snowball, we call ourselves for crypto because we're the first platform that allows anyone to take these portfolios that are curated by these funds and subscribe to them. And so what does this mean for the retail investor? Instead of pulling your hair out and trying to navigate through all these different crypto exchanges that have all these different tokens, instead of timing the market, instead of your wallet and store your tokens in them and then put them in a safe and write down manually what your key is, instead of having robots set stop losses for you in the various exchanges, you can actually invest into cryptocurrencies very seamlessly, very quickly, and in a way that gives you options without the requirement of being an accredited investor, without needing to have a minimum of, a $500,000 buy-in or a 12-month lockup. And you could seamlessly shift from one portfolio to the next. The next slide. And so using Snowball is easy as, downloading the app, hooking a payment method by hooking up your bank account. Just like you log into your bank today, you put your username, password. We have integration with banks. You choose which portfolio you'd like to invest in. Now, we don't recommend a portfolio, but we show you all of the different portfolios and what their moving average is over the last 1 year, 6 months, 30 days, 1 hour. So you can see what the best performing portfolio is. You can also see the exact investment thesis of each portfolio, what the allocation is of the tokens, and what the automatic rebalancing is. And so if one portfolio is outperforming yours, out of a click of a button, you could reinvest into a different portfolio. It's as simple as 1, 2, 3. And so the art of investing in cryptocurrencies is simply getting set up, choosing a portfolio, and then watching your portfolio snowball. And so what are the unit economics, right? So this isn't taking into account our #1 user acquisition channel. And before I get into unit economics, we have, as part of a partnership which is run by our CMO, the #1 entrepreneurial followed Instagram that has 3.5 million active followers. They're getting about 2,000 followers a day and 100 million followers in their syndicate. So what does this mean for us? This means that we have an audience of folks who are risk adverse.
Oh, wait a minute. What is that Instagram account that you're talking about? What do they do?
So this is the #1 entrepreneurial followed Instagram account on all of Instagram. And
no,
so
what
this account is called. So it's called Millionaire Mentor. It has motivational lifestyle quotes, and it has a lot of promotions in different opportunities for folks to make money and start businesses and learn about different ways to further their entrepreneurial endeavors.
So that's your customer acquisition strategy?
Well, that is one piece of our customer acquisition strategy, which haven't even accounted for. So if you look at our cost per user acquisition, it doesn't count this model that we have currently built. So at this juncture, we have marketed on this channel 2 times. And this 2 times, we have over 2,000 subscribers. These subscribers are not only subscribed by giving their email address, they've subscribed to push notifications, and we're in the process of choosing 300 folks to be our active beta testers. And so we have a product market fit. We can test our user interface and all the design updates on this core folks of 300 folks before pushing it out to the market. And
this 2.5%, you're using the venture model of 2.2% to 2.5% a year on assets under management. Is that the model?
So the model is actually our platform is free to use. And so for the user, just like you use Coinbase or if you use Roundtable, there's a built-in spread fee. And so there's a maker and taker fee. So we charge the market rate for all of the cryptocurrencies, right? And we build in a 1.5% spread when you're buying and a 1% when you're exiting. And so that's just based off of market. And what we're doing on the back end is we've signed up and partnered with multiple exchanges. And so we're able to buy in bulk and arbitrage to get the best deal possible. Now, this minimum this minimum revenue is 2.5% of assets under management, but it's likely to be up to 6% based on how efficient we could be on arbitraging. And so the user experience is if they go to Coinbase and buy Bitcoin, say it's $6,000. If they go to Binance, it's $6,200, right? But for you to be able to buy on Binance, you have to go through Coinbase. Yes, fiat.
So if you were to get to your 1 billion target by 2021 assets under management, how many investors are you looking to do that with?
Approximately 90,000 investors.
Sorry, 90,000?
That's right.
This is what I see. I'll tell you what I see here. You talked about earlier on that hang on one second, I'm going to go back in your slides. So 99% of the people out there are not capable of investing in cryptocurrency.
Yep.
Now, this is a business that if I were running your business, I would position it in a category that has more money. Not go for a broad category where you have to do a tremendous amount of education, right? People will have to be educated on crypto, how to invest, and so on and so forth. You have knowledge, you have expertise in crypto, and you can conceivably come up with an investment product that is interesting. Now, however, you're going to run into this education barrier if you go after a broad base, unless you find this 90,000 investors that you're looking for, unless you find a category, a segment somehow that is actually already educated on crypto. So the question, the point that you're making about acquiring customers through this Instagram account, I have no idea whether the followers of this Instagram account have any crypto knowledge at all.
Well, it's actually an interesting point that you have. So this Instagram account has marketed several token generation events for cryptocurrencies. And as a result, these token generation events have met their hard cap. In some cases, it's been $15 million. Okay. In other cases, it's been $30 million. So the user base is actually quite savvy.
Do you have a sense of how many? Because you have very clear numbers, right? You need about 100,000 investors who meet that specification that they're crypto-aware investors.
Yeah.
Do you have a sense of whether they have that in their pool?
Well, let me give you an interesting statistic. In March of this year, there was a statistic that was on CNBC, which stated that 8% of the U.S. at some junction had invested into cryptocurrencies. So what does that mean? That means that 8% of the U.S. in March, and that number is only expected to grow as the market returns. And the market, this ultimate sentiment is quite low. But that's because the market is down 70%, and folks are questioning, is this the end of cryptocurrencies? I bought at 19,000, I'm selling at 6. But if you have been in the game long enough, if you look at a weighted chart over the last 10 years, cryptocurrencies have only been increasing in value, and every time it drops, it's gone down 12 times. It's gone down 70%. It's gone down 87%. It's gone down 43%. And so these corrections are quite normal. And so
that's not the question. I'm not questioning that in the long run, crypto as an asset category is going to exist. Sure. I'm just trying to, my job, what we do here is to figure out how entrepreneurs can build businesses in the most efficient way.
Most efficient way, sure.
So I'm looking at your
here's
business.
Another statistic.
I'm looking at your business and I'm thinking about what segment do you go after and what is the go-to-market strategy to reach that segment, which is why I'm asking you the question, is that whether this Instagram account through which you want to acquire your customers, do they have 100,000 customers who are crypto savvy or crypto investors? Because that is going to be, that would be your segment. That's one way to go to market. Another way to go to market is to go after higher net worth individuals who bank differently, who manage their money differently, and you could go get to your numbers, your target asset under management number with a much smaller number of investors, but you're going to have to go through a different channel.
Yep. And so we believe that once we win retail, then we'll be able to win institutions as well. Going vice versa is going to be a much more slippery slope, given that institutions want to have some sort of foundation of success and trajectory before having official partnerships. But with that said, we're in the process of cementing some very, very material partnerships, which unfortunately I can't say the name of. But ultimately, our mission is to unravel global financial inequality, and we're doing that by protecting the retail investor and giving them this opportunity, right? If we wanted to make money, and that was the sole focus of the business, is let's just make money as fast as possible, as soon as possible, then we would be a crypto fund. But we've decided that we want to democratize not only the opportunity to invest in cryptocurrencies, but this access of information so everyone has a chance to win. And if you look at the crypto fund sizes, especially in terms of assets under management, there's really less than one hand that you can count of funds that have over $1 billion assets under management. We have, if we hit 25% of our growth trajectory, which is modeling after robo-advisory companies like, again, Betterment and Wealthfront, et cetera, we have the real opportunity to hit that $1 billion mark. So for us, it's a factor of making a dent in the world by making this opportunity available for everyone. But also, we can't make a dent in the world without making a killer business in the process. And we can't make a killer business without making a dent in the world. It's a perfect marriage.
All right. Well, good luck.
Yeah. Appreciate it. So
you're welcome.
That's
all right, folks. If you like what we're doing here, recommend 1Mby1M to your serious entrepreneur friends. And the word serious is in bold for a reason. Because we see all kinds of entrepreneurs out there. Because we work with very large numbers of people in our community, we see all kinds of people. And some people have very, very unrealistic ideas about how to build a business and what it means to be an entrepreneur. So we are looking for entrepreneurs who understand that it takes many years to build businesses, and it's very, very hard work, a lot of risk, a lot of nerve, and we are interested in working with those entrepreneurs who have a realistic perspective on what it takes to build a business. So resource-wise, everything starts at 1Mby1M.com. You can start reading our blog if you're a very early stage entrepreneur and you haven't really dipped your toes into the business. A very good starting point would be just following the blog. Now, the blog has case study after case study of how entrepreneurs have been building businesses, putting one foot before the other. Actually, what is interesting is because we've been doing this blog series for, a long time. 2005 is when I launched the blog. And we started our Entrepreneur Journeys series on the blog in 2006, at the end of 2006. These days, very often I meet people or talk to people who have been following the blog and have built successful businesses using some of the principles that they have learned from the Entrepreneur Journeys series. And that's really rewarding, The book series also is based on the Entrepreneur Journeys blog series. Every book has 12 to 16 case studies and double clicks down on a particular topic. You can come to any of these free roundtables. They happen pretty much every week. Tens of thousands of people have attended these, over 100,000 at this point, and we are on our 420th roundtable. Our full acceleration program is 1Mby1M Premium, and there we offer you extensive methodology guidance, a full curriculum. We help you with business development. We have private roundtables where we do the actual strategy work. And then if you are fundable, when you get to fundability, we will help you through that process. But when you are ready, we will introduce you to our network of investors when we deem that you are ready. And then we have a lot of clout in the media. We also help you get the word out in the media through that. Go to the website and do the self-assessment. The self-assessment is a series of questions that you should be asking yourself. These are questions that investors ask you. The investors will ask you these questions, so I prefer that you ask these questions of yourselves and get familiar and kind of build a strategy on how are you going to address these issues, because this is a strategic planning questionnaire essentially. If you get stuck, and this is kind of what I was indicating, Elvis, for your purpose, is you're going to have methodology gaps, right? You can go and study the 1M curriculum, and for that you need to subscribe to 1M Basic, which is our curriculum-only option. It's effectively a mini MBA. What you're trying to learn in the context of digital entrepreneurship, you can learn through this curriculum. So it doesn't matter whether you're a doctor or a lawyer or an artist. You can, for $99 a month, that couldn't be cheaper, you can just learn what you need to learn. The caveat, though, is you're going to have to put in the time. See, we don't have any chip available yet that we can take. You can buy this chip and get it implanted in your brain and all the knowledge gets transferred. Right now, given the state of the art in technology in the universe, the only way we can teach you is with you putting in the time and energy to learn. So you're going to have to commit, a good number of hours. If you want to get enough of this curriculum in 1 month, you're going to have to put in 40, 50 hours in that month to be able to digest enough so that you can learn at least the core curriculum. So I cannot tell you more about how important it is for you to plug methodology gaps in building a business. No matter what stream of industry or profession you come from, you have to get the basics of business building in order and under your belt. Do not think you can outsource this portion. You're going to be making decision after decision after decision in building your business, and having a methodology under your belt is critical. Now, go into the website and dig around. Look at what to expect from the premium program, basic program. There are video FAQs, lots of information, deep description of the curriculum. The curriculum is case study based. We offer you case study after case study. We have close to 900 case studies of successful entrepreneurs who have been very generously sharing their journeys and their lessons from the trenches, and that's what we have built this curriculum on top of. It was launched first in 2010, and every month we have added case studies, we've added modules, and it's a very deep, many hundred hours worth of curriculum, and you need to pick and choose where you want to focus your time, where your knowledge gaps are, where you want to beef up your understanding of business. So our methodology is lean, capital efficient, bootstrap startups. So if you out of the gate you need to raise $50 million, this methodology is not going to work for you. So those are considered fat startups, and pharma is one of them, which is why I said early on that pharma isn't something we do well. We do digital health, but digital health is not that capital efficient, capital intensive. Pharma is very capital intensive. Now, bootstrap first, raise money later is a strategy that works very well. We've seen so many success stories of this mode of building businesses that we are, deep believers in this methodology. So that's pretty much it. You have 5 more roundtables this year. So there are 4 in November and 1 in December. I have some travel coming up from Thanksgiving on to mid-December, which is why we don't have roundtables at that time. But you have plenty of options still this year. And then in-person rendezvous in Menlo Park, you can come by either November 7th or November 20th or December 19th and hang out with me, and I'll be delighted to, spend time with you and listen to you, talk to you about what you're doing, brainstorm with you about your strategy. And you can meet other people as well in those sessions. And these happen at Cafe Boroni in Menlo Park. So it's relatively central from the Silicon Valley point of view, whether you're in San Jose or San Francisco or in San Mateo or Redwood City or in Mountain View. It's kind of in the middle. We're very close. It's literally 5 minutes away from Stanford. All right, so I'm ready for Q&A. If anybody has questions, I will be happy to answer. You can use the public chat to ask your questions, or you can dial in. Either way is fine. Let us know. Now, if you have questions about the 1M program, feel free to contact Irina Patterson on the 1M team, irina@1M1M.com. And that's it. Anybody? Questions, comments? Anybody? You're very welcome, Elvis. I hope you found it helpful.
Hey, Shramana, this is Parul.
Yeah, go ahead.
Can you hear me?
Yes.
Well, I was just hoping you could give me a little bit more feedback. I think we got cut a bit short. What was your overall thoughts of the pitch? Where did you feel like we could improve? Where did you feel like there was opportunity? And where would you suggest we go from here?
I think you have an opportunity. It's kind of taking the robo-advisor model and applying it to cryptocurrencies. So I think there is an opportunity. I think you should be very, very tight on the segmentation issue. And I'll tell you one thing that is, I personally have a bit of a problem from a belief system-wise in kind of messing with people who do not have a lot of money and deploying that money in high-risk investment vehicles. And I'll give you an example. There is a reason why rank-and-file investors are discouraged from investing in startup companies. So, our gardener has a friend who's, because we live in Silicon Valley, people meet people across various kinds of, disciplines and strata. So our gardener, who's in the grand scheme of things, he's a poor man, right? He doesn't have a huge portfolio of assets. He has a small amount of savings. He took a large portion of his savings and went and invested this chunk of money into a pre-seed startup of a friend of his. And now he's going belly up, basically. He has no savings. He's getting kicked out of his home and so forth. And I just think it's criminal for an entrepreneur to take money from people like this. And it is not criminal. It is not illegal. But I think it's morally, I think it's criminal because the level of understanding of what this person is doing vis-a-vis startup investment is just not there. So I would like you to focus on people who know what they're doing and not kind of promise things to people who have no knowledge to be able to gauge what you're talking about, whether it makes any sense or not. How you're going to do that is something for you to figure out. But I just think that, if people think that, oh, I'm going to make a huge amount of money out of cryptocurrency, I only have $100,000 in total savings, and I'll go put in $50,000 in this robo-crypto advisor, and then if I lose everything, I'm basically losing everything. And that situation, to me, makes me extremely queasy.
Got it. That's great feedback. So we were planning on adding during the survey when people initially go through onboarding, based off of this calculation, this suggestion of Yale, you should put a maximum of 6% if you're under this asset class as a warning. But then secondly, if you look at volatility and risk, there's actually an analyst that just came out and shared that Amazon stock prices have actually been more volatile than Bitcoin. And in an immature market, if you're looking for quick gains, you're subject to lose your shirt. But if you look at over a 10-year weighted period, it's been a growth. And so ultimately, our goal.
Here's the deal. Here's why I'm giving you this feedback. See, Amazon is a public stock. A public stock has checks and balances built in, right?
That's right.
You're doing a startup company. And let's say and nowadays there is a tremendous amount of ability for people to make a lot of noise in social media. So
sure.
If somebody gets really hit on your platform, or if investor after investor starts being badly hit on your platform, you can generate tremendous amount of bad publicity, which it's not going to hurt Amazon. Amazon is a credible company. It's a public company. A public company in the United States has SEC, has all kinds of checks and balances attached to it. If somebody loses money on Amazon stock, okay, you lost money by investing in a public company. No one's going to pay any attention. But in your case, it can destroy your company. And so calculate, if your 6% is great, so 6% of your portfolio, that means that you are, whatever denomination you think is the maximum or is the minimum that you're talking about. So 6%, let's say you're talking about a $100,000 portfolio, $6,000 is the denomination you're starting with. So you're then saying that you need a minimum $100,000 in savings, and only 6% of that can be invested in the company. How are you going to check that? How are you going to verify that? You need a strategy for verifying that. Things like that. I would even, I would kind of raise that amount. There's a reason why accredited investors are the only ones who are allowed to invest in startups. So if you actually do the math, you will see that you will end up probably somewhere close to the same number as accredited investors. Maybe not that high. Maybe it's going to be a little bit lower, but it's going to be higher tiers than the rank and file. And I think that's better. That's good for you.
Yeah, that's a really interesting feedback that you give, because we put a lot of thought in exactly what you've just said, right? What is the most ethical way for us to do this? And ultimately today, 8% of the U.S., 30% of South Korea, and projected of 49% of South Africa by 2019 will be investing in cryptocurrencies, which majority are retail. So people are going to do this no matter what. And so our goal is, how can we make it as safe as possible? And so instead of us creating our own investment thesis, we've gone and gotten the investment thesis from these funds that are regulatory compliant with the SEC, FINRA, and FinCEN, and they have a minimum of millions of dollars assets under management, so they have skin in the game. And for us, we're actually in the process of getting our registered investment advisor, and so we're actually going to be under compliance in the United States as well. While it's not, according to our attorneys, required, we still want to take every single measure. So if people do opt to play, they actually have a chance.
Yeah. Yeah, so I think, broadly speaking, I would say right now, given the state of maturity of the industry, right now the regulations are also not fully formed vis-a-vis crypto. I think they're going to change and they're going to mature and so forth. So you're going to need to keep an eye on that and so forth. But for the time being,
Sure.
I would focus on segments that are closer to the accredited investor segment, maybe not all the way, but maybe a tier below. But I would, you're only looking for 100,000 investors really to get to the kind of numbers and situate yourself. I mean, maybe in the long run you're going to do something different, but in the next couple of years, next 3 years, you're trying to get to 100,000 investors, $1 billion assets under management. I would try to go after people who have more buffer and who can make more intelligent decisions. And I would go after educated people who have the capacity to study and understand what the hell they're doing. You should not be going after my gardener, for instance.
Sure.
Okay?
Thank you.
You're very welcome. Anybody else? Any other questions, folks? This was a very interesting roundtable. I learned a lot, both about liquid biopsy and about cryptocurrency, and it's all very interesting. I hope you found it as interesting as I did. Okay, well, no other questions, so we will wrap up, and we'll see you next week. Bye, everybody. Thanks for coming.